This quick tutorial will cover an important accounting principle, that is, the economic entity assumption, also known as the business entity assumption, the business entity principle, the entity assumption, and the entity principle. But first, we will start off with a little bit of background for some understanding. When preparing financial statements, a company is expected to follow GAAP, that is, Generally Accepted Accounting Principles. It is the goal of these principles to ensure financial reports convey useful information that can be used to make financial decisions. In doing this, they need to feel confident that personal and business finances have not been mixed. This is where the economic entity assumption comes in. It states that all business transactions must be kept separate from the business owner's personal transactions. Let's look at an example. In the case of a sole proprietor, if the owner pays cash into the business, then the business must record cash coming into its bank account as an asset, and likewise record the amount owed to the owner as capital. In the general journal, we record this as a debit or increase to the cash account and a credit or increase to the contributed capital account. Let's take another example. Pat wants to use his company credit card to buy new clothes for his business meetings. He believes these are business expenses because he must look presentable to new clients. However, these are not business expenses. Clothing is a personal expense and cannot be recorded on the company financial records, as this would violate the economic entity assumption. Let's take another scenario. Betty owns Betty's Donuts. She wants to branch out and add a coffee shop to reach more customers. Since Betty owns both companies personally, she wants to combine the accounting records of both. However, according to the business entity concept, both of these companies are separate entities and must be accounted for separately, even though Betty is the owner of both. And for our last example, we have Jim's Pizza. Jim wants to buy a new delivery car. The company is low on cash, so he decides to pay for the car himself. Jim intends to add the car to the balance sheet of the pizza shop. However, since the car was bought by Jim personally, it must remain a personal vehicle unless the company buys it from Jim, in order not to violate the economic entity assumption. Hope this tutorial was helpful. Thank you for watching.
Created using Powtoon.